What do you make of it?
Yeah, so it looked like a pretty good quarter, especially when it came to the European business. Some very strong trends there. Fares look like they're up pretty, 20% versus 2019, which is really, I think, that's driving a bunch of the strength here. Domestic looked like a good quarter as well. And again, we have yields that are synonymous with fares. We think of them up 20% in both of those markets. And that's about what I think they need to and so I think, that's probably driving some of the strength in the company right now.
Overall, they really are talking about being upbeat going into the fourth quarter as well, optimistic on strong financial results in fourth quarter in 2023, George. How are we getting a breakdown in terms of who's doing the buying, whether business is back, whether this is really leisure spurring the growth?
Yeah, so we just looked at our Airline Reporting Corporation data. It's data that's on all the U.S. airlines. And the trends there, what I really see is leisure, and especially premium leisure, is coming back quite strongly. But business the recovery's kind of stalled a bit. So we kind of see business back at about 75% of what it was in 2019. But premium leisure is getting up above 2019 levels of transaction numbers, so purchase tickets. And so I think that's really driving the strength. The question will be whether, one, will business continue to recover with us going into what looks like an economic slowdown and potential recession? That's one of the questions. And two is, will that leisure traveler, premium leisure traveler, hold up under, the conditions we have right now, high inflation, budget squeeze? I think the premium leisure travel can hang in there, and the dollar's strong, and so that leisure travelers go into Europe and go into Asia, things like that.
What about the cost basis for United, as well as some of the other airlines, George? I think they've gotten some sort of laudits for kind of holding the line a little bit now, sort of not expanding capacity, keeping some of their other costs at least in line, I think, with some of the longer-term averages in order to sort of take advantage of the opportunity out there right now.
I think that's going to be. So the problem is that they were all kind of surging to 2019 levels of capacity in this summer, and they've kind of come back from there, which I think has helped out operations, but that hurts their efficiencies. And still we've got some pretty strong wage inflation in the U.S. market. The pilots have a union union contract that gets renegotiated every so many years. That's being renegotiated now. We hear mid-teens on that. So I think really United's going to have to look for ways to make their network more efficient. They've been doing that. They've been flying bigger airplanes. They had that big Boeing buy of the MAX 9, and they're going to fly that in their network as opposed to some of the smaller regional aircraft. So they should have some tailwind when it comes to that, but it's going to be hard, I think, to drive efficiency, or they're going to need to drive efficiency because it'll be hard to control costs.
George, just quickly, when they say that they're looking at cutting fourth quarter capacity that'll be about 10% lower than 2019 levels, is that good because they gain from that pricing power, or is that because they can't fill the seats, so they're cutting capacity?
I think if you look at the market right now, you have to believe that the air travel market is a little smaller than it was 4Q last year because of higher fares, which are due largely to fuel. And so I think when they look at that, if all the carriers in the marketplace are a little more contained in the capacity they put in, that's absolutely favorable for fares. But I think when United's looking at the market, yes, they're thinking it's not as big a market as it was Q4 last year potentially.